Here's a number you need to sit with before you spend a single dollar on silver. Gold is trading near $4,677 per ounce as of this Saturday morning, April 4th, 2026. Silver is sitting around $73.75. And the gold to silver ratio, that old, stubbornly relevant measuring stick, currently reads about 64 to 1. That means it takes 64 ounces of silver to purchase just 1 ounce of gold. Keep that number close, because everything you're about to hear for the next 20 minutes depends on understanding exactly what that ratio means, what it doesn't mean, and why the people who think they've already figured it out tend to be the most dangerously overconfident voices in the conversation. Today we're talking about old money, not old in some romantic, nostalgic way, but old in the exact, historically documented, financially consequential sense of the word. We're going to examine what a pre-1933 American $20 gold coin actually represents in April of 2026, against the backdrop of the most extraordinary gold bull market any living investor has ever had the chance to observe. We're going to take an honest look at what silver has done, what it's failed to do, and what the legitimate case for each metal looks like once you peel back the tribal enthusiasm that so often gets dressed up as serious analysis in this space. And let's start with a comparison that tends to stop people completely when they truly confront it. Take a pre-1933 St. Gaudens double eagle, that stunning $20 gold coin carrying nearly a full troy ounce of gold, minted in an era when gold coinage wasn't a collector's curiosity, but actual functioning money. That coin, today, in an honest circulated grade, trades very close to its melt value. You're essentially paying for the gold itself with a thin numismatic layer on top. A century ago, that same coin and a stack of Morgan silver dollars existed inside the same monetary universe, tied together by law, by redemption structure, by the architectural logic of a system built by Washington, and ultimately torn apart by Franklin Roosevelt in 1933. Today, that gold coin purchases roughly 64 of those silver dollars in raw metal value alone. The monetary framework that once bound them with legal precision has been gone for 9 decades. That divergence isn't an accident. It's not a conspiracy. It's a consequence. And understanding what kind of consequence it actually represents is the distance between a casual observation and a genuinely sophisticated framework for thinking about what you should hold in 2026 and beyond. What changed wasn't simply the price. What changed was the entire machine. The old system was a government-administered exchange mechanism where denominations were bound together by statute and redemption was a legal right. The relationship between gold and silver today is purely a market relationship, driven by central bank behavior, industrial demand, investment psychology, geopolitical anxiety, and monetary uncertainty. Those aren't small distinctions. They're the difference between a bridge and a river. One was engineered and constructed, the other just flows. Here's what the data tells us right now. Pay close attention, because this is precisely where the emotional narrative and the factual record tend to part ways. Gold's price near $4,700 represents a gain of more than $1,500 per ounce from just 1 year ago. Goldman Sachs, not a firm known for reckless optimism, has held its year-end 2026 price target at $5,400 per troy ounce, pointing to what it describes as structural central bank diversification that no near-term geopolitical volatility can reverse. Central bank demand remains at historically elevated levels. Emerging market institutions have been shifting reserves out of dollar-denominated assets and into gold with a persistence and volume that markets genuinely didn't anticipate. That isn't retail speculation chasing momentum. That is sovereign-level, policy-driven institutional buying. And it has given gold a price floor that most asset classes simply don't possess. Silver, for its part, touched a nominal all-time high of $121.67 per ounce on January 29th of this year, a price level that would have seemed nearly impossible to most analysts just 18 months ago. It's since pulled back and sits in the $70 range today, which is still more than double where it traded 1 year ago, when prices hovered around $34 per ounce. Silver moved with violence, retraced sharply, and left a significant number of investors genuinely confused about whether what they witnessed was a legitimate breakout or an elaborate head fake. And that confusion is itself worth studying, because silver has always been the metal most capable of baffling people at exactly the moment it matters most. What I want you to actively resist with real intellectual discipline is the impulse to take that historical comparison between a gold coin and a silver stack and treat it as a verdict rather than a data point. It tells you what happened. It does not tell you what must happen next. Those aren't the same statement. History is a reference, not a blueprint, and markets have made a consistent art form out of punishing investors who can't tell the difference. The old ratio between gold and silver, the one written into early American monetary law and recalled fondly whenever silver advocates talk about restoring some ancient natural equilibrium, was a legal construct, not a physical law. The universe doesn't owe silver anything. The ratio will be whatever the combined forces of the market, industrial demand structure, and global monetary anxiety determine it should be. Not 1 cent more, not 1 cent less. So here is where we stand at the start of this conversation. Gold is historically expensive, and institutions are still buying it. Silver ran hard, retreated meaningfully, and still sits at levels that would have been considered extreme by any thoughtful analyst writing in early 2024. The gold to silver ratio at 64-1 carries historical meaning. But historical meaning and guaranteed outcome are two entirely different categories of knowledge. And the comparison between pre-1933 American coins and modern bullion, while intellectually compelling, isn't a trading signal. It's a mirror, showing you how monetary systems are born, sustained, and eventually replaced by something the architects of the original system would never recognize. Stay with me, because the part most people get completely wrong is exactly what's coming next. Let me say the thing this space rarely wants said out loud, because it disrupts clean stories, and clean stories are what generate clicks, shares, and that deeply satisfying sound of agreement rolling through comment sections. Silver is not a failed gold. It's a different instrument entirely. One that happens to be priced in the same currency, stored in the same vaults, and coveted by some of the same people, which creates the persistent and misleading impression that the two metals are simply running the same race, with silver perpetually falling behind. They are not running the same race. They never were. Treating them as if they are is the conceptual error that leads otherwise intelligent investors to draw completely wrong conclusions from the historical record. Consider what silver actually does in the modern global economy: electronics, solar panels, medical equipment, advanced battery design, water purification, an expanding catalog of industrial applications that the men striking Morgan dollars in the 1880s couldn't have conceived of with a decade to try. The Silver Institute and most credible industry analysts continue to project that the silver market will remain in a physical supply deficit this year, which would represent multiple consecutive years of the world consuming more silver than it replaces through mining and recycling combined. That isn't a rumor floating around precious metals forums. That's a structural condition, and it coexists alongside the investment demand story, not instead of it. Both are real. Both are pulling on the same relatively thin physical market simultaneously. But here's the complication that silver advocates tend to move past quickly because it doesn't fit the triumphant narrative they prefer. Industrial users are not passive participants. When silver hit $120 an ounce in January, the economics of using it shifted dramatically. Solar manufacturers, among the largest and fastest growing sources of silver demand on Earth, have been actively engineering around the problem. They're funding research into silver reduction in photovoltaic cells. They're testing material substitutes. They're not sitting still and waiting to be priced out of their own business models. This is what markets do. Demand curves aren't rigid lines. They bend, they respond, they reflect human ingenuity operating under price pressure. So the silver bull argument cannot simply be industrial demand plus supply deficit equals guaranteed upside. The honest version of that argument is tighter, more conditional, and those conditions deserve serious examination rather than enthusiastic dismissal. Now, what I want to walk you through next is the question of paper versus metal, of claims versus actual possession, of the real distance between what you believe you own and what you actually control. Because this is the part of the conversation that the broader financial industry has a genuine structural incentive to keep you from examining too closely. Consider the old silver certificate, a beautifully printed piece of paper, government issued, legally authorized, once fully redeemable for silver upon demand. The Treasury began transitioning from silver dollar redemption to silver bullion redemption for these certificates in the mid-1960s. The ability to redeem them for silver of any kind ended in late June of 1968. After that date, a silver certificate was paper. Collectible paper, yes. Historically significant paper, certainly. But the link to the underlying metal had been formally severed by the same government that created it. The thing it claimed still existed somewhere in the world, but if you held only the paper and not the metal, you held a receipt for a party that was already over. This isn't a minor historical footnote. This is one of the most consequential financial lessons the entire 20th century produced. And it's one that most people hear, nod at politely, and then immediately set aside when the next convenient financial product gets placed in front of them. The gap between a claim on an asset and the asset itself can feel like absolutely nothing during calm periods, and like everything during stressed ones. A brokerage account holding a silver ETF is a claim. A digital wallet balance is a claim. A bank certificate is a claim. A vault receipt from a third-party storage facility is a claim. Physical metal in your direct possession is within the limits of what the physical world permits, the asset itself. That is not the same thing. It will never be the same thing. And the moment you genuinely absorb that distinction, your entire approach to thinking about precious metals changes in a way that doesn't reverse. The 1933 executive order prohibiting private gold hoarding is another piece of this history that people reference constantly and get subtly wrong in the retelling. The order did prohibit hoarding of gold coin, gold bullion, and gold certificates. It also included exemptions, among them a limited allowance for gold coin and coins recognized as having numismatic or collector value. The common version of this story, where the government simply confiscated everything without distinction, is historically imprecise. And imprecision in history has a reliable way of producing imprecision in strategy. The real lesson isn't that confiscation is impossible. The lesson is that the rules governing ownership of monetary assets can and do change, sometimes rapidly, sometimes in ways that even careful observers don't see coming. And the specific nature of your ownership matters enormously when those changes arrive. What does all of this mean for the person at home right now, looking at gold near 4,700 and silver near 74, trying to determine whether the old arguments still hold? It means the case for physical metal isn't primarily about price. It's about layers. How many layers sit between you and the value you believe you control? The fewer the layers, the less trust the arrangement requires. That isn't paranoia. That's precision. In a world where geopolitical instability is moving commodity markets on a daily basis, where an elevated U.S.-Iran military tension has been keeping oil prices high and gold demand supported for months, the question of how many layers stand between you and your savings isn't academic. It's the most practical question a serious saver can ask. Now let me give you something more useful than a conclusion. A framework. A way of thinking about gold and silver that's honest about what the evidence actually proves, careful about what it doesn't prove, and precise about what role each metal can legitimately play, depending on who you are, what you own, and what you're genuinely trying to accomplish. Gold at approximately $4,700 per ounce as of this Saturday, April 4th, is expensive. There's no intellectually honest way to frame it otherwise. It's also expensive for reasons that appear durable. Central bank demand, which Goldman Sachs correctly identifies as the structural floor underneath this bull market, is not retail enthusiasm that evaporates when sentiment turns. It is sovereign-level, policy-driven accumulation by institutions with balance sheets large enough to absorb volatility and time horizons long enough to wait out corrections. The emerging market central banks driving this buying cycle are doing so because they want reserve assets that exist outside the dollar system, outside the SWIFT network, and outside the reach of American sanctions policy. Gold provides that. Silver does not, at least not in the same way or at the same scale. That is not a minor point. It is the single most important structural difference between these two metals in today's global monetary environment, and it explains much of the price divergence that's accumulated over the past several years. Gold has become, more explicitly than at any point since the Bretton Woods era, a geopolitical asset. It is the reserve currency that no government controls. That gives it a buyer class silver simply doesn't have access to. And buyer class determines the floor. For the individual saver, the person building wealth from scratch or protecting what they've already built, gold's case as a long-duration store of concentrated value has never been more clearly documented than in this current cycle. If the goal is compressing a significant amount of purchasing power into a small, portable, universally recognized form, gold is the answer the evidence most clearly supports. A single ounce of gold at today's prices holds what would require a massive volume of silver to replicate even at silver's recent highs. Storage, transportation, insurance, the practical logistics of physical metal ownership all favor gold once the amounts involved become meaningful. Silver's case, however, is not the weak sentimental argument that gold maximalists sometimes paint it as. Silver at $73 or $74 an ounce is still more than double where it traded 1 year ago. It posted a nominal all-time high of $121.67 per ounce in January, which means under the right conditions, it can move with extraordinary violence in the investor's favor. The gold-to-silver ratio at 64-1 sits above its long-run historical average, which means, in the precise language of relative value, silver is inexpensive compared to gold by a historically meaningful measure. That doesn't mean the gap closes immediately, or next year, or even this decade. But it does mean that a patient, disciplined accumulator buying silver at current prices isn't doing something irrational. They may simply be doing something early, which feels indistinguishable from being wrong right up until the moment it doesn't. The bridge strategy that many experienced stackers have employed deserves an honest mention here. You build a silver position during periods when the gold-to-silver ratio is elevated. You accumulate volume at accessible price points. You wait for a period when the ratio compresses, meaning silver outperforms gold on a relative basis. And then you convert a portion of that silver volume into the more compact, more internationally liquid, more institutionally respected form of gold. It's a disciplined, multi-step process that demands patience, price awareness, and genuine resistance to the emotional swings that silver's volatility reliably generates. It isn't right for everyone, but for those who execute it thoughtfully, it has historically represented a rational use of silver's most distinctive characteristic: its capacity for outsized percentage moves when conditions align. JON AG wants to know where this community actually stands. Drop your answer in the comments below. Do you believe the gold-to-silver ratio corrects meaningfully from here? Or do you think gold has structurally separated itself from silver in a way that makes the old ratio essentially obsolete as a reference point? Because your answer to that question reveals everything about how you actually think about the monetary system itself. Let me give you the final framework cleanly, because this is the piece that cuts through everything we've covered today. There are 4 questions worth asking before you make any precious metals decision. The first, what are you actually trying to accomplish? If the answer is long-duration wealth preservation in concentrated form, gold earns the advantage clearly. If the answer is tactical accumulation with meaningful upside potential and the willingness to tolerate real volatility, silver remains a legitimate vehicle. If the answer is both, then the real question becomes allocation, not selection. The second, how many layers stand between you and what you own? Paper gold, whether it's an ETF, a futures contract, or a digital balance, is a claim on gold, not gold itself. That distinction carries real-world consequences that calm markets conceal and stressed markets expose. Physical possession reduces the layer count to the minimum the physical world allows. That carries value that never appears on any brokerage statement. The third, do you understand what has changed and what hasn't? What's changed is the monetary system, the industrial demand structure, the global reserve landscape, and the regulatory framework governing precious metals ownership. What hasn't changed is that gold is gold and silver is silver, that tangible assets held directly carry a fundamentally different quality of ownership than claims administered through third parties, and that human beings confronting genuine uncertainty still reach for things they can hold in their hands. The fourth, does your position actually match your reality? A retired person managing a substantial estate has different needs than a 25-year-old assembling a first serious savings position. A collector drawn to history and craftsmanship is buying something genuinely different from a pure bullion investor focused on metal content at minimum premium. None of these people are wrong. They're simply playing different games, and confusing the games produces confusion about outcomes. The honest conclusion, the one JON AG will always bring to this community because you deserve it, is not a slogan. Gold has earned its standing as the cleaner, more stable keeper of significant value across long periods of time. That reputation is justified. It's documented. It doesn't depend on nostalgia or tribal loyalty. Silver has earned its reputation as the more volatile, more industrially entangled, more emotionally demanding metal, one that can deliver exceptional results in specific windows and quietly frustrate you through long stretches in between. Both reputations are accurate. Both metals serve a legitimate purpose depending on what you're actually trying to do. What neither metal will do is rescue you from your own confusion. If you can't explain in one plain sentence why you own what you own, the asset isn't working for you. It's just sitting there waiting for you to make the wrong move at the wrong time. So clarify the purpose before you allocate the capital. Understand that a paper claim and direct possession are not interchangeable. Know that historical ratios are reference points, not promises. And remember, every time someone hands you a bumper sticker version of a precious metals argument, the market's favorite activity is making that bumper sticker look foolish at precisely the moment everyone started repeating it. This is JON AG, and this is what real precious metals thinking looks like.